Welcome to the Eternal Bright Light channel. Today, we present before you the second part of the mutual fund series videos. Today, we will discuss about the various types of mutual fund available in the market. As an investor, especially if you are new to this, you will find it very confusing to choose the right type of mutual fund. So, it is very important to know about the different types of mutual fund and the significance of investing in them. Now, those of you who haven't seen the first part yet, please see it first to have a better understanding on what a mutual fund really is. Link has been provided in the description below. So, we already know that mutual funds pool money from investors and invest them in the market to generate profit. This profit is shared amongst the investors in the form of capital gain or dividends after deducting the expense costs of the fund. We also know the basic structure of a mutual fund company and how they operate. Then, we also have a basic understanding of the pros and cons of a mutual fund. Now, let's begin our today's lesson on the types of mutual funds. Broadly speaking, mutual funds can be divided into two types, based on which section of the market the mutual fund invests its money. There are two ways it can invest the money. Either in the stock market in the form of equity or shares, or in the debt market in the form of bonds and other debt instruments. But it's not as easy as it may look. Within these two types, there are further subdivisions. We need to understand them as well. So, let's start with the subdivisions of equity mutual funds. Let's begin by understanding the meaning of the word cap. Here, cap refers to the market capitalization of the companies in whose shares the fund is investing its money. In simple words, capitalization means the size and value of a company. So large cap funds invests in the shares of those companies which have a large market capitalization. These companies are generally well known and famous because of the size of their business. So, large cap funds invests around 80% of the fund's money in these companies. The advantage of this fund is it offers stability. It is generally one of the most stable types of equity mutual fund. Therefore, you will not see sudden unusual rise or fall in the returns. This type of fund is ideal for long-term investors who seek stability and also not willing to take too much risk on their investment. Next, the mid-cap funds invests in the shares of the companies who are just below the large-cap companies in terms of market capitalization. The mid-cap funds will generally invest around 65 to 90% of the fund's money on the shares of these companies. So, the mid-cap funds offers less stability compared to the large-cap fund. But, as the risk increases, so does the chance to make profit. Therefore, mid-cap funds are suitable for investors who are willing to take higher risks, as this type of funds can offer market-beating returns. Next, the small-cap funds invest in the shares of the small companies, who are even lower than the mid-cap companies, in terms of market capitalization. These companies are generally not very old, and are still in a rising stage. The small-cap funds will generally invest around 65% of the fund's money in such companies. So, the small cap fund is the most risky form of equity mutual fund. But, as the risk is higher, so the potential for return also increases. Because you mustn't forget, every big and famous company was once a small cap company. Therefore, this type fund is ideal for long-term investors with extremely high risk tolerance, and there is a good possibility of capital erosion as well. Then there are some special types of equity mutual fund, called the multi-cap fund and flexi-cap fund. We won't go into the details of these funds today, as we will make a separate video on this topic. For now, just know that these two funds invest in all the above three categories of mutual funds. But the style of the investment differs in both of them. This has made them a very popular form of investment in the modern world. The debt mutual funds invest in corporate bonds, debentures, government securities, treasury bills, and other money market instruments. As debt instruments are less risky than equities, so the debt mutual funds are also less risky than the equity mutual funds. However, with reduction of risk, the possibility of high returns is also less. Therefore, this type of fund is appropriate for investors who are risk-averse and looking for stable growth. Now, the debt funds can be broadly divided into three types. First, based on the tenure of the debt instrument in which it is investing its funds. Second, the liquid debt funds. And third, the gilt and money market debt funds. Based on the tenure of the debt instruments, it can be further subdivided into various types, like overnight funds, which invest in debt instruments having maturity period of only 1 day, or ultra-short funds, which invests in debt instruments having maturity of 3 to 6 months. Similarly, there are other categories also, like short, low, medium long and long, each of which has different maturity period. Just remember one thing: the longer the maturity of a debt instrument, the more it becomes sensitive to interest rate changes. So, the funds that invest in long-term debt instruments are more sensitive and risky than the shorter ones. So, based on the risk tolerance of the investor, the appropriate fund should be chosen. Next, the second type of debt fund is called liquid fund. These funds invest its money in debt and fixed income securities, which have maturity of up to 91 days. So, as the name suggests, this type of fund has high liquidity. Liquidity means the ability to convert to cash or cash equivalent in a very short time, with little or no loss of value. Therefore, this is suitable for investors who has idle money in their savings account and want to earn more interest than a savings account provides, but also do not want to take risk, and also looking to build a type of an emergency fund. Finally, comes the gilt and money market funds. The gilt funds invests in securities like central and state government bonds, which generally has long-term maturity of around 10 years. These funds are less risky and the default or credit risk is almost zero, as they are backed by the government. Therefore, this type of fund is suitable for investors with low risk tolerance. The money market funds invest in money market instruments of average maturity up to 1 year. For those of you who do not know what a money market is the segment of market which primarily deals with loans of short-term nature. This market is mainly used by big corporates such as banks and primary dealers. This type of market is of a highly liquid nature. Therefore, the money market funds are suitable for investors who want to earn a better return than a savings account, and also have a low risk tolerance. Now that we have a basic understanding of both equity and debt mutual funds, let's look at a special type of mutual fund. We are talking about hybrid mutual funds. Although these funds also invest in equity and debt securities, what makes them unique is that they invest in a mixture of both equity and debt assets at the same time. This fund tries to achieve long-term capital growth and also offer regular income in the short run. The hybrid funds tries to reduce the exposure of the equities by using the debt instruments, thereby making it less volatile than a normal equity mutual fund, while also provides portfolio diversification and higher than debt mutual funds. Now, let's look at the type of hybrid mutual funds. Broadly, it can be divided into 5 types, based on the ratio of equity and debt instruments, in which it invests its fund. The conservative funds invest 75 to 90% of its asset in government securities, treasury bills, bonds, or debentures, and the rest, 10 to 25% in equities. Therefore, the conservative fund is stable, but offers higher return than a normal debt fund, and provides capital gain on the long term. The aggressive fund is quite the opposite of a conservative fund. It invests 75 to 80% of its money in equity and the rest 20 to 25% in debt instruments. Therefore it is more risky, but also offers better return than a conservative fund. The dynamic fund also invests in a mixture of both equity and debt instruments. But what makes it special is that it can actively rebalance its portfolio as per the prevailing market conditions. This fund therefore offers steady and recurring return in the long term, while also reducing the risk by actively balancing its portfolio. The multi-asset funds invests at least 10% of the fund's money in 3 different sectors, comprising of equity, debt instrument, gold, real estate, and similar other sectors of the market. This fund provides a stable and consistent return over time. Suitable for investors willing to invest for more than 3 years. Finally, the equity funds invest 30 to 35% of its fund in equities, while the rest is invested in debt income funds and arbitrage. This type of fund generates more return than fixed deposits, and is ideal for investors with moderate risk tolerance. Friends, we have reached the end of the video. But before leaving, let's take a quick glance on the comparison between equity and debt mutual funds. Equity funds invest in shares, while debt funds invest in debt securities. Equity funds are more risky and less stable, while debt funds are less risky and more stable. Equity funds can provide medium to high returns, while debt fund generally provides low to medium return. Equity fund is suitable for medium to long-term horizon, while debt fund is suitable for short and medium-term horizon. Finally, the size of the equity fund is important. If the fund size is low, then it affects its capability to provide good returns, while fund size is less significant in case of debt funds. We will end it here today. Just remember, what we discussed today was only a brief overview. There are many more things to learn about them. But, if you understood our today's lesson, then it will definitely help you creating a better understanding on mutual funds. The idea behind today's lesson was to create a fundamental understanding about the various types of mutual funds. While investing in real life, make sure to always do your own research and consult expert advisors. We will talk about another important concept in the third part of the video. So subscribe to this channel, and if you found this video helpful, then share it with your friends. Goodbye friends. Take care, see you soon.